particular modules that I taught regarding stop runs and raids and utilization of what a concept I call Power 3. We will be revisiting that in this particular module, and we're going to be focusing on true day. Okay, what is true day? True day is a concept that it outlines or gives the framework to the overall daily range and how the dealers work within those specific time frames. We're going to be talking about the implications of that and the blending of True Day and Power 3 together to give you a more clear view as to what's going on a daily basis in the marketplace. And we're going to be introducing the idea of stop runs and false price swings. And we're going to be building on the framework that leads us into the next two installments where we start dealing with a lot more specifics as to how stop raids are utilized, how they are set up before they happen. You'll know exactly when to anticipate that occurring, and if you happen to miss it, how you trade with it on the left side of your chart. In other words, how do you use it if you've missed the opportunity, or if you were an unfortunate loser in a particular setup that you had taken action in. If it stopped you out, how do you go back in and take advantage of the raid that you were unfortunately a participant in? So let's get a better look at what specifically we're going to be dealing with in this series, and let's go over to the price charts and build some foundation for this particular teaching. Okay, we're looking at the British pound versus the US dollar, or what we commonly refer to in Forex as the cable. Okay, I want to ask you a question, and this is going to be more or less framed on the basis of what we shared in the first and second installment of this series. And I'm going to ask you, we outlined the idea that in the middle of this 2014 time frame, we had a pretty significant high placed in the British pound USD pair. And we talked about the framework that led to being the catalyst for that high in the marketplace and the subsequent low in the dollar index in the first of this video series. And then in the second installment, we were talking about further um, details as we utilize these higher time frame macro principles. Okay, now we're going to take it even one step further, really going to give you the understanding to build the framework for you as a developing trader or someone that's been doing it for a long time that just doesn't have the consistency that you're looking for, or you actually have intermittent consistency, which is typical of uh, moderate length of time in terms of trading. For those that have been in the markets for a while, you still may not be as consistent as you'd like to be. This particular module is actually going to be a supercharger, okay, for those that aren't familiar with some of these concepts. They're absolutely unique to me, and I think you're going to be very blessed by it. And I want to ask you a question looking at this chart. When we see the high in the markets like this, okay, when we're looking at the price up here making its high, okay, and then starting to trade lower, the common question is that the noobs or neophyte traders, okay, I don't mean that to be rude, okay, it's just what it is. I was a noob a long, long time ago too. The looking at charts like this, I was always intrigued with what was the catalyst that led to these moves like this? Because my understanding is this, and it's probably along the same lines as you as a trader. Okay, you look at these charts and you say to yourself, man, if I could just know when the market's going to do this, okay, and then have these prolonged moves, all I could do is simply to sit back and wait for these types of moves, okay, and then I would just trade those and hold on to it and do very well. And I would agree with that. Okay, the problem is the retail universe and all of the pseudo gurus and teachers out there that supposedly know what they're doing, they don't teach what we're teaching in this entire series. Okay, and the reason why they don't teach it is A, they don't know it. Two, they've never been exposed to my work. Okay, or three, they may know it and aren't sharing it with you. Okay, and that's absolutely within the realm of possibility. So I'll leave you to decide which one your particular guru is, or author, or teacher. Okay, that you have had exposure to, which one of those three camps he or she resides in. Either one, okay, you've been left in the dark as it relates to this type of information. And I can assure you that if you're blown away by this installment, you're going to get absolutely knocked out completely, okay, with the subsequent, five installments behind this one. Okay, so knowing that in advance, and I know there's a whole lot of build up, as we're talking here, and you just want me to get right into it. I just want you to understand something. This was the beginning foundational turning points for me to be consistent. So a lot of folks will email me over the several last 4 years or so, really, since I've been specifically teaching only in Forex. 1998, I was in commodities trading. Okay, I didn't have as much feedback then, and I wasn't really readily accessible then as I am now in the Forex industry. So I get a lot of feedback via email, 300 to 400 emails on a daily basis. So there's a lot of, you know, correspondence I get and questions. And the number one reoccurring question is, how do I know, or how can they, as the emailer sending the inquiry to me, how can they know with certainty that a particular move is underway? And I will say this: I don't know with absolute certainty that a move is going to ensue. Okay, I never, no one never does that. Okay, but I can give you the highest probable conditions where those moves that we anticipate, where they will reside and how they'll occur. Okay, I may be off by one day, okay, in terms of a higher time frame turning point. Now, again, I'm saying this with the understanding that I do not want you believing that you can go in and pick major tops and major bottoms on a consistent basis. You don't need to do that, okay? But once you start seeing these major tide changes, okay, on the higher time frames, it gives you the confidence to work within that overall directional premise. Okay, so a lot of folks will ask me, how do I know if the day's going to be up or down? Well, I really never know that for certain. Okay, but I'm going to give you again the framework to know how you have statistical odds that you can look at and go back over your charts and look at it. Okay, and study it on your own. Don't take my word for it. Don't let me just give you the examples in this video here. You, as the developing trader and viewer of this series, I want you to go back through your charts, whether it be Forex or whether it be any asset class you want. Go back and look at the markets like this, and you're going to see clearly that there's an absolute reoccurring phenomenon that goes on and on and on every single day, and it happens consistently enough that even if you're wrong once or twice in a week, you can still go out in that same week, if you're controlling your risk, and if you've taken a loss, you can pull that loss back to a break even and even move to a profitable state going into the close of that week. Now, because we are looking at the higher time frame premise like this, and we're looking for the overall institutional order flow on a higher time frame, what we're looking for is this major move higher or major move lower. Okay, but how do we know when we can anticipate those types of moves, and then what do we do once they occur? What should we anticipate seeing as a result as these moves take place in the marketplace? So what is it we're looking for? Well, obviously, looking at this chart, we can clearly see that the market made a high. Now, I know everyone out there is saying, okay, great, wonderful, Michael, this is a hindsight, perfect scenario. I know, obviously, it's a high. We all been seeing it for the, half of the year going by in 2014, I'm sure. But looking at the cable like this, okay, focusing specifically on the fact that we made a higher high right in here, okay, this is a raid on those participants that were selling short up here. Now, this right here is a raid. How do I know with absolute certainty that that is a raid? Well, you never really know until on a daily basis the very next day. The very next day is here. Now, I'm going to ask you a question. If you are trading and you say, okay, I want to be a part of moves like this, and if you're telling me that you have to absolutely be in on this day here or you're not going to be satisfied, well, turn the video off because I don't have anything for you. Okay, but my question is this: if you were one day late, you were Johnny come lately, and you were in on this day or even the very next day, does that really bother you in the grand scheme of this huge move going down? Okay, it's possibly going to go lower going into the latter part of the year. Closing this year out, we may be going into, a much farther decline on the cable. We don't know that, but looking at this chart here, we certainly know that the probabilities are certainly there. Okay. Now, I want to ask you also something like this. Okay, when we made the higher high here, okay, we learned in the very first video of this series, we qualify price swings with the dollar. Okay, and I introduced the concept of an ICT USDX or US dollar index SMT divergence. Now that's SMT, smart money technique, or SMT, which is smart money tool. What it is you're looking for a break in correlation. Now, if this in fact was a confirmed high, market structure should be confirmed with a lower low at that same time in the dollar. Okay, remember the British pound USD is going to be a mirror image of the dollar index. So if this is going lower, we should be seeing a move higher in the dollar index. But more specifically, how do we know when there's professional accumulation and distribution going on in the marketplace? Because think about what that's saying to you is, if you're looking at the charts with that understanding or that premise in mind, not looking at indicators telling you if it's overbought or oversold, looking for specific divergence, bearish or bullish, that means absolutely nothing. If you're going to reach for indicators to tell you whether or not you should be a buyer or seller, okay, you're taking the eye off of what's important. Everything you need to know about the directional premise of a particular asset class is going to be revealed in the market by looking at simply the chart itself. Do not look at anything like a MACD. Don't look at a stochastic. Don't look at an RSI. Don't look at anything of that nature. No CCI, none of that stuff. It means absolutely nothing without the framework or premise behind it, as we're just going to disclose in this particular video. Now, let's take a look at the dollar index. Now, let's take a marker of this. We're looking at the first week or so, the first 2 weeks of July. Okay, we made a higher high in the cable. Now let's go over and look at the dollar index at the same time. And we can see that the dollar index was absolutely unwilling to go lower. You see it had made a higher low there. Okay, so comparably, what this is showing to us is, again, it's the ICT USDX SMT divergence. Now it sounds like a whole mouthful, tongue twister, okay? But just understand this. All it's saying is that the dollar is unwilling to go lower when the cable was willing to make a higher high. Whenever you see a break in that correlation, because there should always be a higher high in one and a lower low in the other. It doesn't make a difference, just flip it. Okay? In other words, if the cable was making a lower low, there should be a higher high being made in the dollar at the same time. If you start blending time of day, if you start blending day of week, if you start blending quarters of a year, every 3 months, there's a cycle that takes place like this. Okay, if you're looking for intermediate term swing trading, and we're going to talk more about that specifically later on in the series. Or if you're a position trader, okay, if you look at seasonal tendencies on an annual basis, okay, like we were discussing in the first video series of this video series, we can narrow down when the overall probabilities, okay, for a particular move to take place. Now, let me ask you a question. This is going to be very, very fundamental and elementary question, but think about this for a moment. When do you anticipate snow? If you're in a region in the world where you get snow, because I know some of you guys live in the tropics and you just don't know what snow looks like unless you've seen it in a movie or such. But when would you anticipate snow? Obviously in your winter months. Okay, I live in North America. I live in Baltimore, Maryland. So I know, coming into November, as early as November, sometimes as late as March, sometimes even early April. Sometimes we'll get a freak snowstorm. Okay, that's seasonally, when we would anticipate snow. I would never anticipate snow in June. It just wouldn't happen. I would not anticipate that. Now, I know you're probably thinking, okay, what's this have to do with anything? Well, it means this. There are specific cycles in the money flow, okay, that goes through the marketplace. Okay, and there's a seasonal tendency where it's so generically inherent for a market to move higher or lower around specific times of the year. If you just simply wait around for those times of the year and do these principles that we're teaching from the higher time frame perspective, it will absolutely make trading easier than it is for you right now. Now, notice I did not say profitable, because I can't make a promise that you're going to be profitable because I can't control how you're going to use this information. I'm not going to be there to put the trades on for you and close the trades out when it's the optimal time to do that. Okay, but I'm going to give you the framework so you can make an educated decision based on the generics that are in the marketplace that no one else talks about, and more importantly, knows how to piece together. That's been my primary agenda, okay, as a trader. I've already tasted success. I know what it's like to make money. Lots of it. But more importantly, what I've done is I've looked at everyone else because actually I have a character flaw, and I'm going to admit that to you openly in this video series. I'm rather narcissistic, if you haven't noticed. I believe that I'm right in everything, okay, and it's not alien to trading. This is the reason why I do not like folks sending me their opinion about the market, what they think is going to happen, because the way I'm wired, I am contrarian to the core, because that's how I've been bred as a trader. I view everything contrarian. So in other words, if the general populace or retail universe is telling me that they believe that the cable is going to go higher, okay, and let's go back to that cable chart. If the populace abroad in the retail industry are saying this is going to go higher, and if you go back and look, everybody was tickled pink thinking this is a bull flag, it's going to go higher. At the whole time, we were anticipating a seasonal decline. We were anticipating a breakdown sooner or later around that same time frame. Okay. Now again, we're looking for the technicals to support it. But if I go into the marketplace, okay, with someone else's idea, the first thing I'm going to do is I'm going to go in and look for the opposite reasons to do that. Okay. That's just the way I am. So I don't want you to believe for a moment that I'm going to give you the absolute get in, get out every single day of the week type of trading. I'm not going to be able to do that, okay? Because I don't trade that way. Now, if you're a nutcase and you have to do those types of trades, then sure, these tools will help you be in there all the time, every single day, between the London kill zone, the New York kill zone, okay, and those specific times of the day that we'll be teaching specifics on, okay, you'll have opportunities to trade. Some trading setups will be better than others, okay? But if you work within the framework that's being divulged in this particular installment here, this will give you the basis to frame all your types of trading that you could ever imagine, because it's working off of the higher time frame. Okay, so I know I'm going on a long-winded rabbit trail, okay, but I want you to understand that there is absolute power in what I'm showing you, okay, and don't discount it, don't take it lightly, okay, and I promise you, if you study these concepts and you put it to task, you will be far better beyond where you would anticipate have been in terms of development than you had not done it at all. Okay. So now with all that preamble, let's go and look at what specifically we're going to be talking about. This SMT divergence where we made a higher high in here on the cable that was not reflected and supported with a lower low in the dollar index here. Okay. That's an SMT divergence. Now, that's not in any books. That's not in any course, okay? No one's teaching it. No one talks about it but me. Now, it's not about being ego, okay? I'm just telling you, you have learned something that is completely alien to the retail universe. They have no idea that this even it exists, okay? Or if there's any significance to it. But what it's telling you is this higher low, okay, is the dollar being accumulated. Accumulated, what does that mean? There's going to be a large influx of buying interest by the smart money. Banks are going to be all over this bad boy trying to get long. They want to be buying the dollar up, buying it, buying it, buying it. Now, the market's only going to move like this by deep pockets. Retail traders are not doing it, okay? The guys that are, on the forums, they are not making this move happen, okay? They may be lucky to be in here intermittently many times, but they're not moving the marketplace, okay? Banks, large funds, they're the smart money. They're the ones that we're trying to ride the coattails on. If we know that the dollar is being accumulated, okay, it's unwilling to make a lower low at the same time that the cable is making a higher high, we understand then clearly this is a stop run. It's running out the highs here. So anything beyond this point here to the right of that going forward, this should be a selling scenario if it rallies. So every rally should be viewed as a suspect rally or a Judas swing. Now, what is a Judas swing? A Judas swing is You ever look at the marketplace, you're sitting in front of your charts, and all of a sudden it just shoots up for no apparent reason to you because you're looking at a 1 minute chart. Okay, it starts vaulting vertical. Okay, you have no idea why it's happened. You immediately start looking at your, your news wires. What happened? Did someone drop a bomb? What's going on? Did someone die? Something. You want to see what's going on. Or the trigger happy guys, they're saying, wow, it's already ran up 30 points. Okay, I'm getting in now. I'm buying it. Okay, have you done that before? I've done that before. I got no problem admitting that type of actions. I've done that. And anybody that hasn't done it, okay, or admits to it, you're lying. Okay, you're just lying. So just, let's be honest with one another. Okay? We know what each of us has done and what you're most likely going to do if you don't pay attention to what's being shared in this video course. Okay? I'm trying to help you avoid all those things. But when we have a premise on a higher time frame like we have here, okay, this is distribution. This is all being sold here. Why would they run it up here like that? Because these individuals over here that were on this high going short, they were right. Well, the banks are greedy just like you and I are. And don't say you're not greedy, guys, because you are. Okay, you want more than you have. By definition, that's greed. Okay? Admit to it. We're all sinners. Okay? Talk to your pastor. You need some redemption. So the bottom line is, when we see these types of things, we can clearly know in advance, okay, going forward, that we want to be selling rallies. Now, what does that look like? What does selling a rally look like? What does that mean? Okay, well, what we're going to do is we're going to talk about the power of three. So before we get into that, I want you to take a look at this chart a little differently. We're all used to seeing candlesticks, but now we're going to go to a bar chart. Whoa, a little harder on the eyes, I know. Okay, but this is how I learned how to trade. Now, the idea of Power 3 comes from several entities. Okay, number one, the first one came to mind was Larry Williams because he taught the open to close relationship. Here's what I want you to take a look at. We're going to use this candle right here, or this bar. The low here, okay, and the high here. See that? Obviously, the close is higher than the open. When I learned from Larry Williams, okay, he taught that he wished that just the zip codes of the traders that were buying down here below the opening, he wished he knew them, because if he could just get in touch with them, he believed that he would do very well in understanding, maybe even, riding their coattails as well. When I heard that, I wanted to go into the marketplace with the premise behind everything that I do that I'm going to figure that mystery out to him. Okay, in other words, if it was a mystery to him, this guy's the one that took $10,000 into $1.2 million, okay, in 1 year, and he did it in 1987 when it crashed. He got hurt a little bit. He's actually up more than that, but ended up making it back to $1.2 million. Now, is he as good as a trader as he may seem in all his works? No, he's not. But guess what? He readily admits he doesn't have to be very good because of his money management. And that's something that we're going to talk about in the end on the 12th video when we talk about mega trades. But if you look at his trading, he doesn't even utilize the things that we're talking about. So while I am something of a protege of Larry Williams, I believe I've evolved beyond his understanding as it relates to price action. I know that's going to be very egotistical sounding to most of you, okay? But I want you to not just take my word on it. I want you to see these things happen in your chart. And when you start seeing it happen real time before it happens, you're going to be like, what in the world? Yeah, it's going to be just like that. It's going to be like, you have no idea how confidence builds on this, and you'll absolutely know what it is you're going to be doing on a daily basis. And you'll know exactly what you're going to do. You're going to look for the specific pattern. You're going to look for a specific criteria, a phenomenon that takes place repeatedly over and over and over again. And then what will happen is you'll know that when markets are predisposed to go higher, you'll know how to view the opening price and what goes on below it, okay, to get in going long and not be fearful of it. Holding on for the entire day and getting out and trying to get the lion's portion of the move, which is what we refer to as the profit release phase of the Power 3. The first of the three is the open, which is the accumulation stage. Either the accumulation of longs or shorts, and then the close is the distribution phase, where whatever the high or low is formed, if it's a down day or up day, okay, those positions are distributed. Okay, so without going into further detail about this chart here, we're going to come back to this chart, but for now, let's go and revisit the concept of the ICT power of 3. Okay, guys, we're looking at the power of 3. Okay, this is an old teaching of mine. We're just going to retouch on some of the salient points with it. I won't spend as much time as I did the last time going through it, but if you've been following me for a long period of time, there's a torrent on the internet. You can go ahead and snatch that older teaching, but I think you'll be pleased to know that this is going to be just as good, just not as long. All right, what is the power of 3? Now, before we as traders obviously can come to the realization of consistency that we all look for in trading, okay, we first have to understand there are 3 consistency factors that you need to implement in your understanding of price action. Okay, and there's 3 cycles, if you will, okay, that I teach, and the first being the accumulation phase. Now, what is the accumulation phase? Well, because we want to be trading on the heels or coattails of smart money, our understanding is we want to be getting in when they're accumulating longs, buying long in the market, okay, and hopefully being a flea on the dog's back, okay, as price moves higher, we would stand to profit as a default based on their actions, not ours, okay? And the accumulation phase can be in the same vein on the short side as well. Before the market goes lower, okay, when we want to be in there, participating on the short side of the market too, before the largest portion of the move takes place, okay? And obviously the profit release phase is when the profits are seen in our trades. This is where we see range expansion. And range expansion is when in terms of speaking of the daily range, okay, if it's going to be an up day, okay, in other words, the opens near the low of the day and the closes near the high of the day, okay, obviously the most likely scenario for that day for profitability was those that are long in the day. Now, because there are traders that are scalping all day long, okay, they could have scalped intraday going short during that up day and made money. And I'm not going to argue against that point. But my question is this: why would you want to do that? Why would you want to stand in front of a freight train when the the probabilities are much greater for an up day based on some of the things we're going to teach now? Why would you want to sell in an up day at all? Why would you want to do that? Why would you want to do that when it's so limited in capacity in terms of profitability versus the really the unlimited side of the longs? Because I've always learned something that Larry Williams said early on in my development in one of his seminars. He said in really strong bullish markets, they will go much further beyond than you anticipated. And it's true. I've learned to accept getting out of the markets early and being content with that. I used to get mad and didn't hold on to that last little bit. But when you start making money like this, you don't really need to worry about all that. Let them keep some on the table for the rest of the people. You got to have some for the rest of the tribe. And obviously the third phase is the distribution phase. Now, the distribution phase is absolutely the opposite of what the accumulation phase is. Okay, whatever position was accumulated, whether it be long or short, the distribution phase is the distribution of that position or those positions held by the smart money. In a bearish market, okay, this would be distributing those shorts by buying it back. Okay, and the public will be selling it, okay, or taking the other side of the smart money. And what we do is we want to be in the middle portion before it happens during the accumulation phase, riding out the profit release portion, and then getting out when everyone else is talking about the move. That's the distribution phase. Okay, that's power of 3. Now, the specifics of Power 3 hinges on the understanding of the opening price. Now, the reason why I'm talking in regards to price with an open, high, low, close bar and not a candlestick is because I want you to clearly see what's going on. This is how I learned it. This is how I studied it in price action for a lot of years, and I want you to learn it the way I learned it. Okay, if you can see it happening in a candlestick, fine, it's wonderful, but it's easier for me to describe to you with the open, high, low, close bar. Now, without having any basis of it being an up or down day, okay, we're just going to look at the opening price. If this is going to be a down day, and there's going to be a lot of things that we can use to build the framework on understanding of anticipating a down day later on as we go through the series, and some of the things we'll be mentioning in this particular video itself. But if we are looking at a down day or a lower close on the daily basis, okay, or daily chart, the move above the opening price is where smart money distributes. What are they distributing? They're distributing shorts. Okay, I'm sorry, distributing long positions, and they're accumulating short positions. Okay, let me rephrase that in case I confused you. Any move above the opening price, smart money will be assuming shorts and unloading longs. And more importantly, in the retail universe, what they'll be trying to do is lull the less informed crowd, or what we commonly refer to as the dumb money or street money or retail universe. They will be lulled into believing that the market's going higher, and they'll buy that move going up. That move above the opening price is what I dub the Judas swing. The Judas swing is a false rally to lull in traders believing that it's going to go higher. Many times the speed at which it moves, okay, is the indication that we look for. Okay, the faster, the thinner the move it is, the better it is. And we know that it's a suspect rally, and we can sell right into that and not have any fear at all. And it's going to be a little bit of a paradigm shift for some of you, because seeing a fast move going up, reactive state and bind will be, I want to buy that as a retail trader. And we as smart money traders, we do not. We look to sell into that. Okay. Now, conversely, if we are looking for a bullish day where the close is higher than the opening, okay, the smart money will be working below the opening price in the capacity of going long, and they will be distributing short positions. Okay, and if they've been holding shorts, they'll unload them below the opening price, and they'll accumulate long positions below the opening price with the anticipation that it's going to be a higher close and be able to profit. Now, much the same thing we talked about as it relates to a move above the opening price for down days. Well, on up days, when the opening price and then there's a move beyond and lower than the opening price, and we'll talk specifically what is the opening price later on in this video. But if we move below the opening price, that move, generally, if it's fast and thin, that will be a Judas swing. In other words, it's going to be lulling the less informed crowd to get in going short, because after all, if it moves very quickly, 10, 15, 20, 30 pips, okay, in a very short period of time, think about it. Most people are sitting in front of your charts. Oh man, I've been wanting to see a trade, and I just want to get in there and do something. And once it starts moving fast, what is it going to trigger inside their brain? You know, you've did it too. You went in there and chased it going lower, and then what's it do? It turns around and spins on a dime and vaults forward higher and higher and higher, and then you're holding on to a losing position because you didn't use a stop. You should have used a stop, but you didn't. You knew better, but you didn't do it. And then you ride this entire daily range against you until finally, you know, around 10 o'clock in the morning, you throw up your guts, for lack of a better word, and you get out. And you rode the entire range against you. And you did that. No one else did that. You did that. Okay. And that's the cycle that goes on a daily basis. If it's going to be an up day or down day, what I just described to you, that's what happens. Okay. So let's look at it more specifically. Now, the typical accumulation, okay, starts at the opening price. What happens at the opening price? Well, obviously, we would like to know in advance that we're going to be anticipating an up day. If we do, we're looking for a down move away from that opening price. Now, how much of a down move? Well, that's dependent upon several things that we can't answer